Welcome. Welcome to the Nichols Tax Update Podcast. This program is produced to provide current information about U.S. tax law, cases, rulings, IRS pronouncements, and expert comments, real experts, on hot topics. You are receiving it as a member of the South Carolina Association of CPAs as a member benefit. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I want to clearly acknowledge the value of my subscription to Tax Notes Today, published by Tax Analysts, the premier provider of solid, reliable federal income tax information to practitioners, accountants, lawyers, enrolled agents. Rely on this source above all others as being the authoritative source, and I rely on it as well. You'll find references to their material and a few odd quotes in my presentation. Not that the quotes are odd, it's just I guess there's no way to recover that, is there? Anyway, what's in this edition? 6 topics. It was an average week. No tax-exempt status for a girls' softball team. Form 7202, a new form for self-employed persons to claim COVID tax credits. You'll be interested to get a look at the form and a little clue on how it works. And then frequently asked questions on the recovery rebate credit. Next, a practice unit on LIFO record-keeping requirements. As you know, we've talked about those practice units, the IRS training materials in this program before. Then a very rare tax court decision, I mean really rare, allowing a taxpayer to recharacterize an asset transfer by applying the step transaction doctrine to treat it not as a merger, which its contract supposedly required it to do, but to treat it as a Section 351 transaction with different tax results. We'll talk about how that works and why. Finally, final regulations tell us what penalties are still deductible after the expansion of Code Section 162F in the Tax Cuts and Jobs Act. The girls' softball team, as many amateur athletic undertakings, discovered that they needed to have a taxpayer ID number, which meant they needed to organize, and so they filed the EZ form to seek tax-exempt status so they could be an entity. Well, they incorporated, then they filed as an entity so that they could have a bank account. Well, first of all, you don't have to do that to have a bank account, but the articles of incorporation here were just standard off the internet articles. They failed to state a purpose of how the assets will be distributed upon dissolution, and the organization's recreational activities for adults does not further a substantial non-exempt purpose. So the organization is neither organized nor is it operated, those two touchstones, remember, exclusively for one or more exempt purposes. Unless its articles of incorporation limit its purpose and provide for disposal of its assets upon dissolution by distribution to one or more exempt purposes, it fails. And this application for exempt status fails. Now, the application was made in the EZ application, so it's going to be a couple of years before these girls find out they are not a tax-exempt organization. No doubt there will be some minor kerfuffle about that, but they'll get over it. The information here, what's important is these small athletic teams, the high school drill team, the jazz band, a small baseball team, a bowling league, probably don't qualify for tax-exempt status, and so you shouldn't waste your time and energy trying to do that. It isn't important anyway. We have better things to do. Form 7202, there is a picture of the top of the form where a self-employed person can calculate their eligibility for sick leave and family leave credits. Sick leave credit is at the top, that's in Part 1, and family leave then is at the bottom of the form in Part 2. It's published with 2.5 pages of detailed instructions, 35 lines, 24 lines in Part 1 are dedicated to information supporting sick leave credit. 11 lines in Part 2 dedicated to claiming the family leave credit. Now remember, this is a self-employed person attesting to their own circumstances. This is a a self-bestowed credit. Self-employed persons, however, are entitled to take advantage of these credits in the same way as they would if they were an employee of someone else. 2.5 pages of instructions, 35 lines. Frequently asked questions. Eligible individuals may claim this tax credit, the recovery rebate credit, on their 2020 tax return if they didn't qualify or didn't receive the full amount of economic impact payments, plural, to which they were entitled. However, unlike the economic impact payments, the credit amounts are not protected from offset or seizure to satisfy certain unpaid liabilities. So if you got the recovery rebate credit, and if you got the full amount of the payments to which you were entitled, you won't be claiming a recovery rebate credit. The recovery rebate credit can be seized or redirected, if you will, by the Internal Revenue Service to pay certain liabilities. For other coverage on that, go back to Nichols Tax Update Podcast number 2105 on February 1st, 2021, item number 7. The title of the item is IRS May Pursue Late EIP Claimants' Debts. A practice unit on LIFO inventory records. Here is this businessman. Looks like he may be taking inventory of a hardware store. Maybe he's a CPA. He looks pretty conservative. His dress is there. He's got a jacket and a shirt, a tie. He looks conservatively dressed. But maybe that's the CPA checking the client's inventory. These wonderful thing about these pictures is they let us add our imagination to the otherwise dry material. This practice unit, which is an IRS training program, joins these other practice units on LIFO. One, adopting LIFO. The other, introduction to dollar value LIFO, which is a particular kind of LIFO, and LIFO conformity requirement. By the way, dollar value is the most common. Probably 90% or more of the LIFO that you're going to encounter will be dollar value LIFO. As part of the IRS Library of Training Material on last in, first out inventory documentation and valuation rules. Other topics covered in recently issued practice units, you may recall, include these two for partnership debt issues, determining liability allocations, and recourse versus non-recourse liabilities. Those were issued in December of 2020, and the titles don't exactly tell you, they don't give away the subject matter. The subject matter is very important in dealing with partnership borrowing, partnership debt, and how debt can increase a partner's basis in the partnership. Finally, well, maybe not finally, the step transaction rule is applied here by the taxpayer. Complex Media, TC Memo 2021-14, reminds us that there is more than one way to skin a cat, and a taxpayer may, in certain circumstances, be able to invoke the step transaction rule to protect their own step transaction. How could that be so? Well, usually taxpayers are bound by the form they choose for a transaction. There is no same as doctrine allowing a step in a transaction to be ignored or a step to be inserted solely to avoid an unfavorable outcome. For example, a sale and a lease are different, and a corporate liquidation has certain legal characteristics that are different from a sale of some corporate assets. The issue arises when a taxpayer realizes a different form of a transaction from the form chosen would have reduced income tax. In Complex Media's case, the one that we're bringing to your attention, and we found an illustration of steps. In Complex Media's case, the steps that they took were not what was contemplated in a contract that they signed, the paperwork, if you will. The paperwork had Complex Media merging and this and that. There's a fairly complex corporate restructuring. The corporation contracted to redeem the interest of a shareholder, however, that could not be done without a preceding merger with a corporation that had the cash, which was required for the redemption. So Complex Media treated the merger and subsequent redemption of the shares, so the merger, the distribution of cash from the merged entity, and the subsequent redemption of shares as a Section 351 transaction, with the cash being boot, not a merger, as the paperwork apparently called for. But never mind, the tax court said. The paperwork did not say how the deal had to be done. Complex Media was free to structure the transaction the way they did. So the transaction was an acquisition of assets in exchange for stock. But one of those assets was enough cash to buy out a partner who threatened to block the deal. The Section 351 treatment allowed Complex Media to capitalize some cost of assets acquired and to amortize that cost. Next, we're going to revisit briefly the final penalty deduction regulations because they're important. They deal with whether or not a taxpayer may claim a deduction for paying a fine or a penalty. As you recall, the Tax Cuts and Jobs Act expanded the Section 162 limitation on deducting fines and penalties to include, and this is a limitation, which includes those paid under the government's direction as well as those paid to the government. But it created a reporting requirement for the payee governmental agencies under Section 6050X. I'm going to come back to that. So the final regulations provide definitions and other guidance on exactly how this exception to the general disallowance is going to work. You can deduct some of these payments for restitution and remediation if they are paid to comply with a law. The regs here introduce a new term, origin of the liability. Now, I'm familiar, as you are, with the origin of the claim doctrine. There's a wealth of litigation and learned treatises on the origin of the claim doctrine. They didn't want that. This is intended to be different from the origin of the claim. The new test looks to the particulars of the relevant statute or rule, not so much to a factual inquiry into the events around the violation. So my introductory remarks about the Tax Cuts and Jobs Act are sort of repeated here, but let's go all the way to the middle of this paragraph. This reporting requirement, and the changes in the statute created an exception to Section 162F for amounts paid for restitution, for remediation, or to come into compliance with the law, with a statute. That's where the reporting requirement comes in. The deduction depends on the government agency's reporting of the statutory basis for the liability. So the taxpayer here is well advised to pursue the proper reporting of the transaction by the governmental agency as required by Code Section 6050X. Well, gang, until next time, please stay safe. We need all of you.